Hello everyone. We will discuss some special scenarios that are covered under the IFRS 15 in this part of the video. So first, let's start with forward repurchase agreement or repurchase arrangement. If you go through the literal terminologies written down in the IFRS 15, then you will be confused. But if you if you analyze the situation with some common example, then it is so simple. So just go through the examples what I will discuss here later, and you will be understood fully. You will understand at ease. Okay, so let's start with the forward repurchase contract. A repurchase here means seller is selling the product to buyer, and some terms of the agreement is there to repurchase that assets from the seller. That is a repurchase. Sell and repurchase. Sell and taking back. So how the IFRS 15 will be applicable there, and how we are going to recognize the revenue, what will the accounting treatment, we will discuss those aspects in this special scenario. Okay. Forward repurchase. First is forward repurchase contract. That is, there is obligation to repurchase the assets from the seller. And that is just simple and clear, because the repurchase is from the person who sold the assets or who sold the goods. And here is obligation. The terms of the contract is seller has the obligation to repurchase the asset what he has already sold to the buyer. Then at a future date, the seller should purchase the assets which he has sold to the buyer. Then first check whether there is transfer of the risk and reward associated with the assets to the buyer or not. Whether there is transfer of the control of the assets from the seller to buyer or not. No, there is no transfer of the control from seller to buyer, because seller will be going to repurchase that assets from the buyer in future date. Then there is no question of the transfer of control of the assets. So there is no control of the customers, so that there is no sale. There is no role of IFRS 15. Even though this is a contract of revenue with customer, but there is non-applicability of IFRS 15, because there is no transfer of the control of the assets to customer. Let's analyze two situations. For example, ABC Limited is an electronic supplier, and ABC Limited is making a contract to supply a PC, personal computer, worth $10,000 to XYZ Limited. However, there is a condition in the agreement that ABC Limited will repurchase that PC after 3 months. Repurchase PC after 3 months at $12,000. It is a contract of revenue with customers, and ABC Limited is a supplier and XYZ Limited is a buyer. And ABC Limited is here to supply the PC worth $10,000 to XYZ Limited. But the terms of the contract is such as like to ABC Limited will repurchase that PC at $12,000 after 3 months. Then first we have to check whether there is a transfer of the control of the assets to buyer or not. Here is no transfer of the control of the PC to buyer, because XYZ Limited has to send back that PC at $12,000. He has to sell that PC at $12,000 back to the ABC Limited. There is no control with XYZ Limited, so there is no sale. Then how we will treat those transactions in the books of account. So first we have to evaluate that whether the repurchase price is greater than the sale price or less than the sale price. If repurchase price is $12,000, which is greater than sale price, that is $10,000, then it's not a contract of sale, it's a contract of financing arrangement. Just visualize the scenario this scenario as a different way, that ABC Limited is supplying the PC at $10,000, and ABC Limited is going to repurchase that PC at $12,000 after 3 months. And what's the plan? What's the main motive of ABC Limited for this transaction is to finance the short-term need, or to borrow the $10,000 for period of 3 months, and to provide the security of peace. That if any company is in need of the finance, shortage of the finance, then the company can make a sale agreement to a buyer, and supplier can provide the assets to customers, but with the condition of repurchasing that assets at a higher price, so that the supplier can handle the situation of financial need at the short term. So we have to consider that $2,000 as a finance cost. We have to treat $2,000 as a finance cost. 10,000 received as a financial borrowing, and it should be treated as a financing arrangement. It is not covered under the IFRS 15, but it will be treated as financing arrangement, not a sale, because there is no transfer of control of the assets from seller to buyer. And it seems like that seller is arranging the finance from the buyer with security of providing assets to buyer, so that he will get $10,000 now and he will pay $12,000 later. So $2,000 is a finance. So $2,000 shall be amortized over the period of 3 months. That will be discussed another IFRS. Okay. Let's take the contrast scenario, a reverse scenario. That like ABC Limited has entered contract with XYZ Limited to supply PC at $10,000. And there is a term in the agreement that ABC Limited will repurchase that PC at $9,000 after 3 months. Then this is a forward repurchase contract. This is an agreement, but there is no contract of sale, because transfer of the control of the assets from ABC Limited to XYZ Limited is not there, because there is no control of the buyer with the assets, because he has to sell back to the ABC Limited after 3 months. That's the term of the agreement. Then this is not a sale. There is non-applicability of IFRS 15. XYZ Limited is in need of PC, a personal computer, and XYZ Limited doesn't want to purchase that asset, but just want to use that assets for a certain period of time. Then what XYZ Limited can do is to make an agreement with ABC Limited to purchase that computer at a certain price, like $10,000 in this example. Then with the terms and condition of the agreement, that the seller or supplier, that ABC Limited will repurchase that assets after the usage period, that is 3 months, at price below the sale price, that is $9,000. What it looks like, it is similarly like as a lease agreement, because XYZ Limited is first paying $10,000 to purchase these assets and reselling that assets. ABC Limited is first selling that assets to XYZ Limited at $10,000, and XYZ Limited is selling that assets at $9,000. And XYZ Limited has to pay $10,000 and receive $9,000. That is $1,000 as a lease charge, $1,000 as a lease payment. To make the scenario simple, the XYZ Limited can make a lease agreement to use the PC for 3 months and pay $1,000 as a lease charge. That will be covered as per separate IFRS, which will discuss about the lease. In other way, the XYZ Limited can make an agreement, forward repurchase agreement, that to purchase the assets at $10,000 and to sell that assets below the selling price, below the original selling price, that is $10,000, and that difference amount looks like a lease payment. So that will be covered as per separate IFRS on lease, not as per IFRS 15. Okay, so let's discuss another special scenario, that is a repurchase call option. Repurchase call is the right of the seller. If seller is making an agreement with buyer that he will sell a product and then he will have the right to repurchase that assets, then again there is no transfer of the control of the assets, because there is no right lies with the customers, but right lies with the seller, that he can repurchase the asset. That is a repurchase call option. That is the scenario of repurchase call option. It is similar like case of forward repurchase contract. It is also a right of the seller or obligation of the seller to repurchase the assets at future date. If that repurchase price is lower than seller price, then it will be considered as lease. If repurchase price is above or equal to the sale price, then it is called as financing arrangement. Similar in the case of repurchase call option. If repurchase price is less than sale price, like the example or scenario discussed earlier, like that ABC Limited is making an agreement to supply a PC to XYZ Limited at $10,000, and there is a call option for the ABC Limited to repurchase that assets at 12,000, then it will be considered as financing arrangement, because no seller is going to make that agreement if there is no need of finance. ABC Limited is in certain need of the fund, so that he is making the agreement to selling that assets to collect the fund. Here is the main objective is not to sell the assets but to collect the fund, to make the arrangement of source of fund, that is $10,000, and after a certain period of time he will again purchase that assets which has already been sold to XYZ Limited at a price more than of the original selling price, that is 12,000, which is more than 10,000. Then it will be considered as a financing arrangement. And another reverse scenario, if XYZ, so a buyer is in need to use the assets for a certain period of time, so that agreement can be made between ABC Limited and XYZ Limited to supply PC at $10,000 and buying that PC at price below than the original selling price, that is $9,000. Then it will be considered as lease. In one way that XYZ or ABC Limited can make a lease agreement directly to provide the PC on lease with a certain rental charge. In another way that ABC Limited and XYZ Limited can make a contract of sale with a repurchase call option, that supplier will be going to repurchase that assets at the price below than the original selling price. So difference between the original selling price and repurchase price is considered as lease amount, that will be treated as lease, and the separate IFRS on lease will cover this scenario, the both scenario. So it's the similar case alike of the forward repurchase option. Now let's imagine that if the right lies with XYZ Limited or buyer. Let's take the scenario that ABC Limited is making an agreement to supply, what is the obligation? To supply a PC at $10,000 to XYZ Limited. And there is a condition within the agreement that XYZ Limited can exercise the option to resell to ABC Limited. What is the difference between call option and put option? In the call option, there is a right lies with the seller, and in the put option, the right lies with the buyer. Then that ABC Limited is making a contract to supply a PC worth $10,000 to XYZ Limited, and there is a condition that XYZ Limited has the right to resell PC to ABC Limited. Let's say at $12,000 after 3 months. Then let's look at this scenario in a different way. What will happen after 3 months? Here is no right lies with the ABC Limited. Right to resell lies with the XYZ Limited buyer. XYZ Limited is a buyer, ABC Limited is a supplier. Then after 3 months, after the using the assets for 3 months, there is a right lies with the XYZ Limited to sell that assets a price more than the original selling price. Then what will do after 3 months? He will certainly sell that assets at $12,000. First benefit is that he used the assets for 3 months. He has already used the assets for 3 months. That is the first benefit. And second benefit is that he will gain $2,000 after reselling that assets to ABC Limited. So the contract has the terms that the right lies with the XYZ Limited, that he can resell that assets to supplier. Then XYZ Limited is certainly gonna to exercise that option. So in that situation, there is no sale, because there is a condition or there is a terms of the agreement, and the likelihood from that terms of the agreement is that XYZ Limited will resell that assets to the original supplier. Then there is no transfer of the assets from seller to buyer at the first time. Then look at this scenario in a different way, that ABC Limited is need of $10,000. So that ABC Limited entered the contract with XYZ Limited to supply the PC as a guarantee, and after the agreement the ABC Limited will get $10,000 to use for its purpose, and after 3 months that XYZ Limited resell that assets to ABC Limited for $12,000. So difference between the 10,000 and 12,000 is like as a finance cost. So it should be treated as a financing arrangement, because likelihood of exercising the option from the buyer is 100%, that because he is going to get the amount which is more than the original selling price. So he will certainly going to exercise that option to resell the PC to ABC Limited. So it should not be treated as a sale. It should be treated as a financing arrangement. ABC Limited, XYZ Limited. ABC Limited is supplying PC at $10,000 to XYZ Limited, and there is a condition within the agreement that XYZ Limited can resell PC at $9,000. Then prima facie XYZ Limited has the right to exercise that option, that is put option. Buyer has the option to exercise. Buyer has the right to exercise that option. Then XYZ Limited is not a stupid personality or not a stupid entity that it will going to exercise that option, that after using the assets it will sell at the price below the original selling price, because there is no benefit when there is exercising the option, when exercising the put options, that is to sell at $9,000. It seems like that the direct loss of $1,000. Only one benefit, that is to use the assets for a period of time, let's say 3 months. Then we have to look at another terminology, that is expected resale price, expected market value of that time, that is after 3 months, expected market value. If the repurchase price or reselling price from the buyer is below than the original selling price, like 9,000 is below than 10,000 original selling price, then we have to consider the expected market value at that time, that is after 3 months. If the expected market value, let's say expected market value is 9,500, and whether XYZ Limited will be going to exercise put option or not, because if XYZ Limited can sell the PC at $9,500 to the market and can sell that PC to an original supplier at $9,000, certainly XYZ Limited will exercise to sell that PC to the market. He will not resell that PC to the original supplier or seller, that is ABC Limited. Then it will be considered as a sale, and here will be the applicability of IFRS 15, and it is a contract of sale, because there is a certainty of not exercising the put option from the buyer, because expected market value at the time of exercising option is more than the resale price of the agreement. In contrast, if there is expected market value of $8,500, which is below than the resale price option, then buyer will exercise the option of the agreement, that is put option of the agreement, that he will resell the assets to the seller, original seller, because he will get $500 more than from the market. He will not be going to sell that assets to the market. Then this is not a situation of sale. Originally we cannot recognize that $10,000 as a revenue, but ABC Limited has to recognize that $10,000 as a lease, as a contract liability at first, and difference between $10,000 and $8,500, $1,500 as a lease. And there will be applicability of special IFRS which discusses on those are the 3 scenarios. That if there is a forward repurchase, what is the forward repurchase contract? That there is obligation to repurchase that assets from the buyer, which then seller is going to exercise that option and forward price. Then there is no transfer of the control of the assets from the seller to buyer. Then there is no sale. There is no applicability of IFRS 15. So if there is repurchase price is higher than original selling price, then it will be considered as financing arrangement, because seller can make an agreement with buyer to get the fund from the buyer, and after with mortgaging of the assets, and after the certain period of time that seller will repurchase that assets at a higher price than original sale price, then it will be considered as a financing arrangement. If the repurchase price is less than sale price or original selling price, then it will be considered as lease. The difference between the price, sale price and repurchase price is considered as lease. And for a repurchase call option is a right lies with the seller. So it's just like the similar scenario of the forward repurchase contract. It is also not a sale. It is not a contract of sale, and there is no question of recognition of revenue. So there is non applicability of IFRS 15. There is application of the lease, IFRS on lease, and it will be dealt as operating lease or financing lease as per the condition mentioned on the IFRS discussing on the lease. Or if there is a repurchase price is higher than the selling price, then it will be considered as financing arrangement. And in third scenario, that is the repurchase put option. That put option is the right that lies with the buyer, not with the seller. Right to sell from the buyer. Then there might be the two possibilities. One is repurchase resale price or repurchase price is higher than the original selling price or equal to original selling price. Then it will be considered as financing arrangement, because there will be certainty of the exercising the option from the buyer. And if there is a resale price is less than original selling price, but resale price is greater than expected market value, then there is also certainty of exercising the option from the buyer. Then it will be considered as operating lease as per IFRS. Another possibility, that resale price is less than selling price, but expected market value, resale price is also less than the expected market value. Then there is certainty of situation that buyer won't exercise that option because there is no benefit from the exercising that option. Then it will be considered as sale. Okay. And those are the three special scenarios of repurchase arrangement discussed in the IFRS 15. Now let's take exam questions that has been asked in the IFRS exam. That ABC Limited enters into a contract with XYZ Limited for sale of machinery on 1/1/2023 for $2 million. Okay. ABC Limited is a supplier or seller and XYZ Limited is a buyer. The contract includes a call option. Call option right lies with ABC Limited. That ABC Limited has the right to repurchase that machinery for 2.1 million on or before 31st December 2000. Here the resale price is, repurchase price is $2.1 million and original selling price is $2 million. Then it will be considered as a financing arrangement, because no business house is going to enter into a contract that there is a certainty of loss in the agreement of 0.1 million, that is $1 lakh. But by looking that situation, but looking that example in a different scenario, we will understand that ABC Limited is in shortage of the $2 million. So that ABC Limited enters into contact with XYZ Limited to sell machinery, so that the ABC Limited can collect the $2 million from the XYZ Limited, and after a certain period of time ABC Limited will buy that machinery at 2.1 million, so that by financing $2 million to ABC Limited from the XYZ Limited can get the $0.1 million as an interest. So it will be considered as financing arrangement, not a sale, because there is no control of the assets within the buyer, that is with the XYZ Limited. Control of the assets is within the ABC Limited. So it's not a contract of sale, it's a arrangement of finance. Arrangement of financing $2 million from XYZ Limited to ABC Limited. Like this is the answer here. XYZ Limited does not obtain the control of the assets, only has the limited ability to use. Therefore, ABC Limited should account as financing arrangement, not as a sale, because repurchase price is greater than the sale price. Money received from XYZ Limited shall be recorded as liability and 1 lakh shall be recognized as interest expense in the books of ABC Limited and interest income in the books of XYZ Limited. Second scenario, if the time expires and no right has been exercised, then it shall be recognized as revenue. Even after the expiry of December 2023, there is no exercise of the option from the ABC Limited, then that is a certain sale. Then ABC Limited can recognize the revenue. Okay, let's add another situation within this example. If the contract has been entered as put option, that is right is with the customers and repurchase price is the same as above 2.1 million. In above sale price, it shall be treated as same as case 1, because there is certainty that XYZ Limited will exercise that option. Because put option is, what is put option? Put option is the right to sell from the buyer side. And if there is a certain benefit, then buyer will exercise that option, that XYZ Limited will get $2.1 million after reselling that assets to ABC Limited. So that will be considered as a financing arrangement. The difference between the reselling price 2.1 million and original selling price $2 million, that is $0.1 million will be recorded as interest expense in the books of ABC Limited and interest income in the books of XYZ Limited. That should not be considered as contract of sale, and there is no applicability of IFRS 15, that is revenue from contract with customers. Okay, let's add another scenario in this example, that if there is put option to exercise at $19 million, that is below the original selling price, and the expected market value at the date of exercise is 19.8 million, then there is no chance of exercise option from the customer, because if XYZ Limited will sell that assets to the open market, then XYZ Limited will get $19.8 million. But if XYZ Limited exercise the put option, then it will only get $19 million. So there is certainty of not exercising the put option from the buyer side, so it will be considered as sale. So ABC Limited can book the revenue of $2 million when entering the agreement with XYZ Limited. Let's add another scenario within this example, that if there is put option to exercise at $19 million, however the expected market value is $18 million only, then XYZ Limited will exercise the put option from the agreement, because it is beneficial to sell to the seller instead of sell to the market, because market value is only $18 million, but resale price is $19 million. So there is certainty of exercising the put option from the buyer, so it will be considered as lease. It will be considered as lease as per IFRS 16. There will be applicability of IFRS 16. Okay, you can take the screenshot. Move forward to other special scenarios that discussed in the IFRS 15. First is consignment. In case of the consignment, in case of the agreement of consignment, the parties to the consignment agreement are not considered as principal to principal basis. They are considered as principal to agent basis. Like, let's take an example, that there is a hype of Puspa trailer. Everybody is chanting the name of Puspa. Everybody is doing the action like Jhukega nahi sala. So you came with the idea to sell noodles in the brand name of Puspa, that you make the noodles of Puspa, but there is already established brands of noodles in Nepalese market. India there is Maggi instant noodles. In Nepal there is YY, Rara, Rampam. So nobody is going to purchase that noodles. So you came with the idea that you will supply the noodles to the wholesaler, the main wholesaler of the key location within the country of Nepal, and you will guarantee them that any risk, any loss to the storage of that Puspa noodle will lies with you. There is no need to worry about the loss of the breakage or loss of the not getting the price. Everything is guaranteed by the seller, you. And when you have told the supplier that when supplier resell that noodles to other consumer, then he will get the commission. And if he cannot sell that noodles to other consumer, then he will get the refund. The supplier will get the refund for the whole purchase. Then it will be considered as a contract of consignment, not a contract of sale, because there is no transfer of the risk and reward from seller to buyer, from you to wholesaler, from noodle manufacturing company to wholesaler or distributor. Then it will be considered as contract of consignment, not a contract of sale. Like Puspa noodles is delivered to shop as a showcase and no inventory risk to the restaurant, because just a new brand. Obligation only when restaurant finally sells it to customers. Then it is a consignment arrangement, not a sale. Product, in case of the consignment agreement, product is fully controlled by the seller until a specified event occurs. Seller can require the return or transfer to another party. Seller can get the product back to the own store, or that agent can transfer back the product to the seller. Customer does not have the unconditional obligation to pay. Then it will be considered as a agreement of consignment, not a contract of revenue with customers. So the inventory lies with the consignee or agent is also considered as inventory of consignor, transferor, seller. So that should be included in the valuation of stock of the seller. That should be included in the financial statement of the seller. And that's the main point. Then let's look at the another scenario, that is sale with the right of return. That if the seller is making a contract of sale to customer but with the condition of right to return from the buyer within a certain period of time or within a refund of certain percentage, then it will be considered as sale with a right of return. Then seller should not recognize that revenue at first because there might be the possibility of returning of the goods from the customer. Then that's not a case of full transfer of the control of the assets from seller to buyer. So it's not a sale and it should not be recognized as a revenue. So if there is a refundability less than 100%, then we should calculate the weighted probability estimate, that what percentage based on the past data will return the goods, and we have to adjust that probability of a refund within the transaction price, and only we can recognize that adjusted price as a revenue, like we have discussed earlier part of the video in IFRS 15. And this is the scenario. Okay, yeah. And if there is a condition of 100% refundable, then it should not be considered as a revenue at first. The seller or service provider or supplier can book the revenue only after the expiry of that refundability condition. Like 100% refundable condition shall be booked as revenue only when the right to return expires, otherwise it shall be treated as liability. Okay, and third special scenario here is bill and hold arrangement. That supplier has already sold the goods but that goods remain in the possession of seller. That will be considered as bill and hold arrangement. The supplier has already billed to the customers, already sold the product to the customer in the paper, but possession lies with seller. And if there are reasons which are substantive and product has been separately identified and stored in the warehouse of the seller, separately identified, that product has been already sold to Mr. Ram of Biratnagar, that has been already separately identified, separately stored in the warehouse of the supplier, then it will be considered as sale. Otherwise it won't be considered as sale. The scenario of this bill and hold arrangement, that there are two performance obligations what we have studied earlier. First, we have to go through the terms of the contract. Second, we have to identify the performance obligations separately if that can be identified. Here are the two separate performance. One is to deliver the product and other is to provide custodial service, that to store that product for the on behalf of customers. That will be considered as custodial service. So there are two separate performance obligations. One is to sell the product, or one is to deliver the product to the customer. Second is to hold or store the product for the customer for a certain period of time. That is considered as custodial service. So transaction price shall be segregated towards those two separate performance obligations, that for a product and for custodial service. Those are the special point discussed in the bill and hold arrangement scenario. But before that be considered as a revenue, reason must be substance. Product shall be separately identified within the store of seller. That should be separately identified, separately stored, and should be ready for physical transfer. And seller cannot have the ability to use the product or to transfer it to another customer. Then only it will be considered as revenue. Then only the question arises of the separating the transaction price to the custodial service and the product. If the seller has the discretion to establishing the price, if the seller has the discretion to transfer that assets to another customer, then there is no satisfaction of the terms of the contract of the sale. That won't be considered as the contract of sale, because there is no transfer of the control of the assets from seller to buyer. Then there is no applicability of IFRS 15. Okay. Before the IFRS 15, there is a separate standard for the construction contract and other revenues. But after the application of IFRS 15, there is only one single standard for the revenue from contract with the customer, the revenue from the operation of the main business. Then IFRS 15 is also applicable to construction contract. And what is the main difference between normal sale contract and construction contract? Normal sale of the product contract, then that there is you have to deliver the product, you have to transfer the product to the customer, then you will get a consideration, you will get the transaction price, then you will book that as a revenue. But in the case of construction takes place over the period of time, not in a single year or not at a point in time. So to break down the construction price or construction contract amount to the over the period of time, we can use the two methods. One is output method and other is input method. What is output method? That we can segregate or we can recognize the contract price on the basis of output, on the basis of percentage of completion of work, percentage of work completion. Let's say Pappu Construction has entered in an agreement with Kathmandu Mahanagar KTM Metropolitan to construct overbridge at $10 million, and the Pappu Construction has to complete the construction within 5 years. Then there are two methods to bifurcate that 10 million over the period of 5 years. One is output method, that you can recognize as per the percentage of work completion. That is output method. What you have done, on the basis of that you can segregate the whole transaction price over the period of time. Other is to allocate that transaction price on the basis of input method, that is how much you have spent over the construction within a year. And as per output method, let's say the first year and second year. As per the output method, let's say you have completed 20% till the end of first year and 35% at the end of second year. Then you can recognize the revenue 10 million into 20%, 10 into 20%, 2 million at the end of first year, and 10 into 35%, that is 3.5 minus already recognized revenue, that is 2 million, 1.5 million at the end of second year. That is output method. Let's say on the basis of input method, that you can allocate that transaction price on the basis of cost that construction company has already incurred. Let's say first year cost incurred, cost of raw material, cost of cement, steel, labor, that is 1 million. Second year, that is 2 million, and total estimated cost is, let's say, $8 million. Then in the first year you have to recognize the revenue 1 divided by 8 into $10 million. And in the second year you have to recognize the 2 divided by 8 into 10 minus that already recognized. That's the method discussed in IFRS 15. Either you can follow the output method, that is on the basis of work completion, or you can follow the input method, that is on the basis of cost incurred by the construction company. Input method is cost based method, that is cost of raw material, cost of labor, cost of cement, cost of iron, steel. Discuss the presentation and disclosure that has been discussed in the IFRS 15. Those are the cost to obtain contract, that as per the matching concept, that cost that has been incurred to earn that revenue, to accrue that revenue, that should be booked in the period when the revenue has been recognized. So similarly, cost to obtain contract here means capital, like sales commissions, and that should be capitalized as a contract assets and amortized over the contract period, because cost to obtain the contract for a whole contract, so that should be allocated to the whole price of the contract, that should be amortized to the whole period of the contract. Cost to fulfill contract, that is cost of inputs like labor cost, raw material cost, that should be amortized over the contract period. Similarly, in the case of cost to obtain contract. Then other are the non-capitalized costs, that is administrative and overhead cost, cost to obtain the unsuccessful contract, that you have paid the certain charge to bid a government construction contract, but you did not get that contract, then it should be expensed up within the same year. And this is the last part about the presentation and disclosure, that in the income statement we'll show the revenue from the operation. When there is satisfaction of the condition, the satisfaction of the performance obligation, that is transfer of the risk and reward from the seller to buyer, or transfer of the control of the assets from the seller to customer, a seller to buyer, then it will be recognized as a revenue at a point in time or over the time. That will be presented or shown in the income statement. Other is cost that we have just discussed. And in the statement of financial position, first terminology here is contract assets. That is unbilled revenue, that you have already worked, that you have already earned a certain amount of, but not billed to the customer. That will be considered as contract assets. That is revenue minus receipt minus receivable. You have already worked for the customer, but you have not billed it. Then that will be considered as contract assets. When you have worked for the customer and billed, and yet you have not received, then that will be considered as receivable, not contract assets. But you have already worked but not billed it, that will be considered as contract assets. So contract asset is considered as earned but not invoiced. And second is receivable, that is unpaid invoices, invoiced minus receipt. Third is contract liability, that is advance consideration received from the customers, that is amount invoiced minus amount of revenue the customer has paid in advance. Is a condition of variable consideration, that customer can get refund with the loyalty points or reward points in the future. So that should be recorded as contract liability, not as the revenue.